Penny stocks, the hidden truth nobody tells beginners. Consider that some of the most significant stock market gains in history originated from companies initially trading for less than $5 per share. For example, a stock valued at 50 cents may eventually reach $5. A $1,000 investment in such a stock could potentially grow to $10,000. These narratives attract millions of investors to penny stocks each year. However, there is a contrasting perspective to consider. For every penny stock that achieves success, hundreds are delisted or become worthless. Many investors enter the penny stock market with aspirations of achieving financial independence. Instead, they often encounter significant volatility, market manipulation, and financial losses. This raises the question, what precisely are penny stocks? Why do these securities attract such considerable attention? Furthermore, how can investors distinguish genuine opportunities from potential risks? In this video, we will provide a comprehensive overview of essential information regarding penny stocks. The following topics will be addressed: the definition and characteristics of penny stocks, the inherent risks associated with penny stocks, methods used by professionals to evaluate penny stocks, common fraudulent schemes and how to avoid them, the psychological factors influencing penny stock investment decisions, and whether penny stocks deserve a place in your portfolio. We will now begin the discussion. What are penny stocks? The term penny stock may seem straightforward. Many assume it refers to stocks trading below $1. However, the definition is broader. In North America, penny stocks typically refer to small companies with low share prices, often under $5. Most are not listed on major exchanges, such as the New York Stock Exchange or NASDAQ. Instead, many trade on over-the-counter OTC markets. These companies are typically very small. Some are struggling businesses. Others may have little or no revenue at all. Many have limited financial reporting requirements. As a result, investors often have far less information than they would with larger public companies. Think about the difference between buying shares of Apple and buying shares of a tiny mining exploration company with no profits. Apple generates hundreds of billions in revenue. The smaller company may have little more than a business plan and a press release. This lack of transparency creates both opportunities and risks. Because fewer investors follow these companies, their prices can fluctuate significantly. However, these dramatic price movements can occur in both directions. Why investors love penny stocks? Penny stocks attract investors for a straightforward reason. They seem inexpensive. Many new investors assume a stock priced at 50 cents is a better value than one at $500. However, this is a common and risky misconception. A share's price provides little insight into the company's actual value. A stock priced at 50 cents may be significantly overvalued. Conversely, a $500 stock may be undervalued. Psychologically, investors are drawn to the idea of owning thousands of shares. Purchasing 10,000 shares can feel exciting. This creates the illusion of significant potential gains. Additionally, there are notable success stories. Bull market produces headlines about tiny companies that suddenly soar hundreds or thousands of %. These stories spread rapidly on social media. Investors may start to believe they have found the next Amazon or Tesla. However, the thousands of penny stocks that quietly disappear receive little attention. The successful companies become well known. Losers become forgotten. This dynamic leads to a strong survivorship bias. Investors notice the success stories, but overlook the many failures. Why penny stocks are so risky? Let's review the primary risks involved. The first major risk is liquidity. Liquidity refers to how easily you can buy or sell shares. Large companies have millions of shares trading daily. Penny stocks typically lack this level of trading activity. You might be able to buy shares easily. However, selling shares can be much more difficult. The second significant risk is volatility. A single news release can cause a penny stock to move 20, 30, or even 50% in one day. While this may seem appealing, volatility can result in significant gains or losses. The third risk involves the quality of available information. Many penny stock companies offer limited disclosures. Some have little operating history. Others operate with business models that are difficult to assess. The fourth major risk is dilution. This is among the most significant dangers for investors. Many small companies frequently issue new shares to raise capital. Each time new shares are issued, existing shareholders own a smaller portion of the company. Even if the business survives, shareholders may experience dilution of their ownership over time. Finally, there is the risk of a complete loss of investment. Unlike established companies, many penny stocks never become profitable. Some eventually exhaust their cash reserves. Others may cease operations entirely. Investors should always keep in mind, a low share price does not indicate low risk. In many cases, it signals higher risk. The pump and dump problem. Market manipulation represents one of the most significant risks associated with penny stocks. A common form of market manipulation is the pump and dump scheme. The process operates as follows. Promoters initiate aggressive marketing campaigns for a small cap stock. They disseminate information through social media platforms. They distribute newsletters to potential investors. They publish optimistic forecasts regarding the stock's future performance. They assert that the company will transform its respective industry. As enthusiasm increases, additional investors are attracted to the stock. The stock price experiences a rapid increase. This phase is referred to as the pump. Subsequently, insiders and promoters liquidate their holdings during the heightened demand. The stock price subsequently declines sharply. This stage is known as the dump. Promoters retain substantial profits from the scheme. Late-stage investors typically incur significant losses. The implication is clear. Extreme caution is warranted whenever individuals guarantee substantial returns. The stock market does not offer guaranteed returns. This is particularly true in the context of penny stocks. How professionals analyze small companies. Professional investors take a distinct approach when analyzing small companies. Their analysis begins with fundamental factors. Key questions include the following. Does the company generate revenue? Is revenue growing? Does management own shares? How much debt exists? How much cash remains? Can the company survive another year without raising more money? Professionals also evaluate broader industry trends. A strong business operating in a declining industry may still face significant challenges. Conversely, a mediocre business in a rapidly expanding industry may outperform initial expectations. They analyze financial statements in detail. They review the backgrounds and track records of management teams. They assess competitive advantages. Most importantly, professionals prioritize probabilities over narratives. Narratives can generate excitement. Quantitative data provides evidence. Successful investing requires a balance of both. However, evidence should always take precedence. The psychology trap. Penny stocks provide valuable insight into human behavior. Many people are drawn to lottery tickets. This attraction is not based on logic. Instead, it stems from the hope they offer. Penny stocks often evoke similar emotions. Investors may envision turning a modest investment into substantial wealth. The allure of this possibility can become addictive. However, investing based solely on hope rarely leads to positive outcomes. Successful investors learn to control emotions. They recognize that investing is not a form of entertainment, nor is it gambling. Investing is a process of capital allocation. Every dollar invested should be supported by a clear rationale. Decisions should not be driven by excitement alone, nor should they be motivated by fear of missing out. A disciplined investor considers the following questions. What are the potential downsides? What risks are involved? What evidence supports this decision? These questions distinguish investors from speculators. Can penny stocks make you rich? The honest answer is yes, it is possible. Some investors have made enormous gains from penny stocks. However, it is important to make a distinction. Most wealth is not generated through penny stocks. Instead, wealth is typically built through discipline, diversification, patience, and long-term ownership of penny stocks can occasionally deliver extraordinary returns, but they can also result in significant losses. For this reason, professional portfolio managers typically limit speculative investments to a small portion of total assets. They avoid risking money they cannot afford. The primary goal is to preserve capital. Preserving your capital allows you to continue investing over time. Penny stocks are not inherently good or bad. They are best characterized as high-risk investments. Some offer genuine opportunities. Others may result in costly lessons. Before investing in any penny stock, consider the following questions. Do I understand the business? Can I verify the financial information? Am I prepared to lose this entire investment? If you answer no to any of these, pause before proceeding. Conduct further research. Remember, successful investing is not about achieving rapid wealth. It is about building wealth steadily over time. Successful investors are rarely those who pursue the latest trends. They are those who manage risk and allow compounding to generate long-term returns. If you found this video helpful, please subscribe to The Illiterate Investor. Financial freedom is not built by luck. It is built on knowledge, discipline, and patience.